S&P 500 closes at major resistance. Nasdaq closes at a 52-week high after major earnings announcements. Why real estate investment trusts and regional banks are seeing massive inflows. Japan's 10-year making a 10-year high on the yield. US dollar versus the Japanese yen and the major confusion that was caused over the past 2 days. Single greatest drop in 10 years, followed by a rally. Why you should care about this. The semiconductor index setting up to take out all-time highs. We're going to discuss the subsector that's driving this. Peak corporate blackout window ends July 28th. We're going to talk about what is the significance of this and how to benefit from it. Smart money, dumb money, confidence, and what it's telling us. We have a lot to go over. Let's get to it. Hey everybody, welcome back. Bunch to go over. First and foremost, 46.31. Here, we can all see that level right here and how it held. Now, what's important about this? We have a neckline, we'll show you that in a moment, and we can see this wonky, here's your right shoulder, head, left shoulder, we can all see that, I'm sure. We flip that, and we flip that neckline, and then we start getting up here again. And then we have this news come out of Japan that a lot of people really aren't following, and we're gonna get into that. It's really important that you at least understand the basics of it, because that's why we sold off, and then why we rallied, and we're gonna discuss that and what it means going forward. But this level has been something that we've been dealing with for a period of time. First, it was rejection here where we stopped. Second, so it's about 3 weeks, even though it doesn't look like it, this little doji here has been playing with us. Now, once we flip that doji, there's a couple other things here that we could look for. I'm going to use this magnet to show you. That's going to take you that 4666, which I really find that kind of humorous that that's the number, but it is what it is. You look at the head, left shoulder, and then you just kind of say, okay, well, where's my neckline? Well, that's pretty glaring neckline, don't you think? We flip that, so the head and the shoulders inverted, flipped. Now, why is this important? And you should be able to see the curvature here, but I'll just pop it in very quickly so we can go over it. I'm sure everybody already saw this, but there it is. So you can see the curvature. Let's take off this magnet for a second. So you can really drill into that. And there you go and see a little bit clearer. And I think that that's really important, just so you get that, because you have a left shoulder, a head, right shoulder. Yeah, that's great. But here's what happened. You come up here and you pull back, and then everyone says, oh, well, clearly that's the high. Well, what does that form? It actually forms a cup and a handle, doesn't it? Something to think about when you start to see this rejection if we pull back and then go. The idea that we're just going to miraculously fall out of bed because people missed this rally, it just doesn't work that way. You can just see where we're at right here and why this area is interesting. Now let's drill into this. Now in front of us is 23. And what I want to point out is a couple things. Number one, this was Thursday. And if you got beat up on Thursday or you got beat up on Friday trading, you're not alone. It was an extremely difficult day. I would argue that Friday was probably one of the more difficult days of the year, quite frankly. But you look at these reversal bars that you're getting here, and I'm marking them here because I want people to truly get what happened. You don't have a lot of bars like this where this happens. Sure, you'll get those bars where you go straight down, but higher highs and then reverse, you have very, very few of those. You could argue you have one here, but that's really a doji. You don't have many bars where you are doing this, where you are rallying up and then you're coming back down. It's pretty rare. You might get a doji or something like that, but if you really look at this particular bar, even here, they usually, quote, usually will mark some kind of short-term top, no matter how long that is or not, it usually marks something. Now, why this one might is because it was news driven. We drill into this more from the daily, and we can do the basics. Everybody knows that you're above the 12, the 22, and the 55. RSI still above 70. And I think that that's pertinent that you held the 12, but these are the basics, and I want to really drill into this so you can see what I'm saying. Now, we're going to start with the hourly. We break down from this rally, which was beautiful. And then we just have 2 hours of straight selling on Japan's news, and we're going to discuss why that news is important in a moment here. Please comment on the detail that you're about to see in the Japan section, because I'm really curious if it's going to be something where you want me to be this detailed on what an actual issue was. It might be too detailed. I always want opinions on that. That does help me create content, so I appreciate it. Now, if you look at this, that is probably one of the hardest things to trade, because what are you going on the assumption of? that you're going to miraculously get over this bar of all this selling? There's no, I'm a pattern trader, so when I look at patterns, there's no pattern here that's going to suggest that we're just going to miraculously lift through this. A matter of fact, this saying, you take the stairs up, people say you take the elevator down. No, you take the window down. And that's exactly what happened here. This was not orderly. This was just get me out, free fall. And what are you doing? You're taking the stairs back up. Now, the problem with this is you still have these levels that have not been lifted. And I think that's really pertinent. If we just look at some of these levels like this 4609, okay, we got above it for a day. Where's my higher high confirm? I didn't get it. I'm just supposed to believe that we're done. We're just going to go back up. Yes and no. I do believe that to some extent because of the news that came out, but I think we just have to take a look. And what I always find helpful if I get a little confused or I'm trying to understand what people are thinking is I just drop fib levels and just kind of get a sense of where we're at. And usually what they'll do is they'll give me some sense of retracement. So we know this is the zero line. You can see how you flipped here. And once we flipped, got up to here, fought that one. And then you got to this 6180. And all I'm doing is taking the range from the news, taking a specific event, and I'm putting fib levels on that event. And that will tell me where the behavior of the traders is, right? Because that's really all you're doing is you're charting human behavior. You look at this and you're trying to get through that 78.6, and then no, you get Matumbo'd up here, reversal, but you hold the 61.8. Okay, so we're above the 50 line. So we're above the 50 line. We remove those drawings and we just do something as simplistic as take VWAP. And when you learn what these things are, you can start saying, oh, well, this makes a lot of sense. And you just drop from that day that news hit. Now, I guess we should argue that the news hit that day, but that's going to give you around the same number, or that bar rather. That's when the doji and reversal kicked in. You look at that and go, okay, well, we're above the 50 and we're above 61.8 on the retracement. And now we're above, I anchored a VWAP to the time of that news. Well, now we're above that. Okay, well, now I should probably pay more attention to this because of those details, because it's telling you that the average person that probably sold here, well, now they're back in and now they're long. That tells me what's going on. Technically, pattern-wise, this is just god-awful to look at. There's nothing here that is redeeming. If I come here, and you can't really see this, but if I put this right here, that's the best I have, are these two dojis up here. And this really does very little for me. Unless I'm going to say, okay, well, we hit here, we flipped, we came back, we retested and going sideways. You can make that argument, but I think that's a pretty strong argument. And just to show the magnitude of this, we're going to just drill into this on a much smaller time frame so that people can actually see what this was like when we fell apart. There was no quarter given whatsoever. And what you can see is just from that selling, it was just down, 3-bar pattern, down, bear flag, down, 3-bar pattern. I mean, textbook stuff. H, failed H, rallies to the top of the H, sell-off capitulation, and then just flim-flam off the morning. And oh, by the way, we might have changed our minds on our statement. We're going to get to that in a moment here. But this is what you were dealing with. And then even after all of this, look what happened. And I think it's a very important distinction. Now, if we just look at the obvious and just be Captain Obvious here, I'm just going to drop this in here. And you can see that level what happened. Well, that's where we had a little battleground before. Well, we lost that battleground. Two things. One, 4610 is a very important level to us. It's a level that we must watch, and we're spending a lot of time on this on purpose. Number two, you need to see how this acts at 4616.25. Now, it's quite possible that as this news is disseminated, that we could have a gap in the market on Monday. To me, I don't really know how that's going to play out because it's ongoing. They added such confusion with their statement that people are looking at it and trying to figure out what the heck they actually meant. Now, what's funny about this is while this is going on, and we're about to address it, look at what's happening here with the Nasdaq. Nasdaq's hitting highs. Not a care in the world. Not a care in the world. Here's your control bar. And you haven't been able to get above that. Been battling it, tries to get up there, no. And then 1, 2, then boom, 3, the push through. Over this gravestone, which we were all talking about, well, let me rephrase that. I know I was talking about it and I was concerned about that going, I don't really want to be playing with a shooting star here. And then what do? The ultimate flim-flam. They undercut us. They make us think that we're going to drop and retest maybe this low. And they just reverse it and rip it. And they've been doing this over and over. And every time we think that there's going to be a pullback, what happens? There's not. That there is a pattern that you're starting to see. And when you want to try to identify patterns as soon as possible. But you can see this curvature here as well, I'm sure. But we're just going to drop that in so you can see it. And what I'm getting at with these patterns is you don't know how this is going to play out. But if you see this pullback here, all you're going to get is a cup and handle. Now, unless you just completely fall off the ground, but straight down is not a pattern. You're going to have another angle here that you're going to be able to work with if you pull back, which is possible here. I mean, we still have this RSI that's way over where it should be. I mean, the RSI, now you're at an 84. That's a really high reading. Now, you can stay up here for a very long period of time, very long. But eventually, you're going to have to work some of that off. Even if it's worked off where you're coming back down to that 70 line and you're riding that 70 line, which we did, just so we're clear, we did for a year up here. And you were over 70 for the majority of 2021. So you can do that. And there are some signs here that is possible to stay up longer. And we can get into it in another video. For this one, we're not going to. Maybe I'll get into it this week as to why that is viable. But you can see where we're at and we'll see what's driving us. Okay, so what's driving us? Do we have a driver? I'm glad you asked. Yes, we do. Semiconductors. There's nothing that makes me happier than when semiconductors drive the market because it's sustainable. It makes sense when semiconductors drive the market. Why does it make sense? Because they're the growth engine. Software, yes, you can implement software into corporations. They do great on gross margins. I'm not saying to not play the software names. Like you look at cloud, that looks amazing, doesn't it? You're finally coming out of that base. You're breaking out here, and we can see that. But cloud, and so as they say, quote, will eat the world. Semiconductors, to me, are the products and the engines that actually make all this works. If you don't have chips, you don't have a computer. If you don't have a computer, you don't need software. It's pretty simple stuff. So if you think about it from that perspective, if you don't have chips, no one's buying software. What are you going to do? You're going to have an abacus. So here we are looking at this and saying, here's your flag, here's your breakout, you're going to push through. You're at all-time highs almost on the stocks. No one's talking about it. Okay. And I always say this, I'm going to say it again, and I'm going to say it a lot this year. You need to cull your social media feed, whether it's YouTube, Twitter, whatever. The idea of the bears and the crash and all this, it's because of likes and comments. They get more of them, the more negative that they are. It's more about that than actually providing information. And it plays with everybody. I will play with everybody's when you start seeing other people's opinions. So stick with your own opinion. Even if you find that this video or these don't bother you or change your perspective in a bad way or don't open your mind, you need to cull it. So it will just change your trading. So, and I think that's really important. I really think that's missed out. I've been watching people watching the video triple waiting for a bottom. It's tripled from the bottom. Anyway, you see where you're at with the stocks here? See what's going on? So why is that happening if AMD's here? Why is that happening if Micron can't get out of its own way? How the heck is it rallying with Intel doing what it's doing, which actually doesn't look half bad here, does it? And the issue is where you are in the cycle with semiconductors. So where are we and why did it take us so long to get there? So here's where you are. This was one we traded in the community, and we did quite well with it. I'm actually going to do a video in the community for this, and I can do one public. What we did was we bought this at $4.80, and then we made about $10, $11 on it, which was roughly the cost of the underlying put for the 480s. Then we married the put to it, and we were able to hold it into earnings, essentially having a free trade. Right? Worst case scenario, I lose my profit and I have the put. And it gave me the flexibility. Let's just say that I opened at 400. Well, now I have the put. I could sell the put, stay long, and see if we bounce and make some money off of it. In contrast, it did the same exact thing here. It allowed me to stay in. If we opened up here, I would have made more money. But I'll take it. I'll take that trade because it netted me money and netted me the ability to stay in it with little to no risk after being up in the trade. But if that kind of videos of interest on how to play these names and marry puts to them, especially going in the volatile times as earnings, just comment below and I'll work on it. And I do want to take a second and say thank you to everybody for sharing these. I actually get emails on it now from people saying, hey, so-and-so shared your video. Even if you have like 12 followers, doesn't even matter. Because the point of it is to get this out there. I purposely don't run ads, and that does play with the algorithm and getting this information out there, so I appreciate you sharing it. I don't really want to run ads in the middle of this while I'm trying to go over a plethora of information that you're trying to digest. So here you are, and you can see this right with Lam Research. Well, what's going on? Why is Lam Research moving like this? Why is KLA moving like this? Why are they hitting all-time highs? What AEHR? did that hit all-time highs? Well, that's testing equipment. Well, what do you need testing equipment for? We need testing equipment to test. Well, what are you testing? Well, what does KLA do? What does Lam Research do? They're equipment manufacturers. Well, who needs equipment? Well, if I'm going to build something, I'm going to need equipment. Okay, so if we're going to build something, then we're going to need equipment. Who makes equipment? Lam Research, KLA, KLIC. Okay, this is all extremely important. Why? Because this is the beginning of a cycle, not the end of a cycle. When the equipment makers move first, you're at the beginning of a semiconductor boom. You're not at the end of it. And there's an actual order to this. What you'll see are names like Taiwan Semi come out and say, oh, well, demand's a little weak. Well, why is demand weak? Well, capacity utilization is off. Well, why? Well, it's off because the inventories are down. Well, why aren't they replenishing their inventories? Well, they want the next big chip. Oh, okay. So you have a cycle that you're coming into, and the firms that have to buy the product from you don't want to buy that product. They want to buy the new product. Do you want to buy the old Xbox or the new Xbox? Think about it that way. So yeah, I want that H100. I want a couple A100 chips. These NVIDIA chips that are going for 40,000. Okay. Well, I can only make 12 a month or whatever godforsaken number they're making around with these chips. I forget what the number is, but you look at it and go, okay, well, that's why Taiwan Semi went down, because people don't want the older legacy chips. They're trying to gear up for AI. And AI is not about ChatGPT, so get that out of your head. AI is about corporations wanting to be able to compete with each other and establish profitability. That's why Goldman said it'll take 10 years. Over the next 10 years, it could add 1% to GDP. Over the next 10 years. And that's the baseline. So just wrap your head around that. That's not me typing into, ChatGPT, if I was an animal, what kind of animal would I be? It's actually important to make companies profitable. Keep that in mind. Here we have Taiwan Semi. So what's going to happen here? Well, they're going to buy all this equipment. They're going to ramp up. As they ramp up, what's going to happen? Okay. As they ramp up, what's going to happen? They're going to produce more chips. All right. If I need more chips, do I need more parts? Yeah, I need more parts of the chips. Well, who does lithography? ASML. Okay. So why is ASML not doing well? Well, I don't have enough equipment to utilize the lithography from ASML. Oh, okay. So as the equipment builds out, it's a 12 to 18 month build out. It's been that way for the past 20 years that I've been trading. And then you go, okay, well, that makes sense. So then ASML will come down the line and the lithography will come there. Well, who's the end user? Okay, well, that's NVIDIA. And their chips are in such demand that if you go back and you listen to Tesla's conference call, they actually say, Elon actually says, I will buy every single thing that NVIDIA will sell me. Period. End of story. Okay, who has their chips in their products? SMCI. Who sells a $144,000 computer? SMCI. Look what's going on there. Okay, that's how much demand is for product. And you can't even get the product. They can't even build it yet. And they're just building it out. And people think this is over. They have no idea. Is the market going to fluctuate? Yeah, it is. It will fluctuate. Can these names drop 100 points? Yes, they can. But if you start putting these pieces together and you start really doing research and start critically thinking about this, you'll understand that you are at the beginning of something. You are not at the end of it. Now, that's really important to grasp as we go through these other pieces, because there's other pieces to this. Japan, why should you care? Why would you care what Japan is doing with their rates? Why did the market sell off? And why did the market rally on Friday after the sell-off? We're going to get to it. But there's an important statement now. This is from the New York Times reporting from Tokyo, and you can see by the date, this is yesterday. And I think it's a very important point that he just brings out there. No country in the world holds as much debt as Japan, which has well over $1 trillion in U.S. treasuries alone. Okay, why do they have so much U.S. debt? Well, if you could sell debt or if you could borrow money at 50 basis points, you can borrow as much money as you want at 50 basis points, okay? And then you go out there and you can buy a 10-year treasury that's paying you 3-4%. Would you do it? Yeah, you would do it all day long. That's why they own $1 trillion. Now, when they raise rates, their cost to borrow goes up. If their cost to borrow goes up, they don't make as much money here, do they? No. If they were doing 50 basis points and they were getting, let's just say 4%, and the net benefit there is 3.5%. You go to 1%, now you're at 3%. Well, you just dropped 12% of profitability by a 50 basis point move. So when you connect the dots, this is why Japan is so important. That and it's 14% of the dollar index. Even the slightest shift to Japan's low interest rates reverberates well beyond its border with the potential to drive rates up globally. If they raise their rates, everyone might have to keep going and raising their rates, because inflation and driving inflation down only works basically in a vacuum. If everyone keeps raising rates, well, then it doesn't solve anything. So when they loosened their grip, Bank of Japan loosened their grip, this is what happened. They had a long-standing commitment of just doing exactly this, cheap money. He really hammers this out in three paragraphs from the New York Times, much better than I could. So I thought it was worth bringing up so people could understand it. Now, careful explanation needed to prevent the market. This is from Japan News, 29th. The Bank of Japan has decided to revise its monetary easing policy for the first time since this new governor took office. I will not butcher the gentleman's name. We all know my pronunciation skills lacking. BOJ is currently implementing monetary easing measures guide the short-term interest rates to -1%, long-term interest rate 0. The central bank has allowed the 10-year Japanese government bonds to fluctuate in the range of around plus or minus 50 basis points. Now, I thought this was fascinating. If long-term yields exceed 1%, the BOJ is ready to take measures to hold interest rates down by purchasing an unlimited amount of bonds. So they're putting a ceiling in there. We'll buy everything. I mean, imagine going out there and being in a market, and this is from the Japan News. Imagine going out there and being in a market and you know where your floor is or your ceiling is. I mean, you could literally just go out there and know, well, no matter what happens, I can get out of my short here. They said they're going to do it, so they're going to do it. Now, why they're going to say the flexibility is commendable, what else are they going to say? This is what's important. There was turbulence in the financial markets following the announcement of the policy revision, and there were huge fluctuations. Now, they're saying they have to do it now, and we'll get into this. We're going to get into this as to how it affected the market and then what they did. But it's important that you can't keep this kind of cap on forever. Now, this is why we moved the way we did, and I got this from an article, Mint, but they really hammered this home, and I believe this is from Fidelity. I believe that this person is from Fidelity, and they just hammer it home perfectly. Now, this is what was so fascinating, and I just want to hammer this one part out. So this is from Mint. On the one hand, they introduced this tweak. Now, the tweak is what we just talked about, where they're going to buy unlimited bonds at 1%, and they're going to keep that, we're going to have this range. They're going to have this big range, but they're telling you where the floor is. The next day, they downgrade their inflation forecast. So you're coming out and saying, we're going to do this with the bond market, but inflation, we're downgrading our forecast. And that's when the market reversed on Friday. That's why Thursday was the sell-off and Friday we rallied. And that's what made Friday so difficult. Now, why is this important? Well, it's important because it's affecting the US dollar. It's important because they buy US treasuries, and they might buy less US treasuries if they're paying 1% versus 50% or 50 cents to borrow money, 50 basis points rather. So you understand that, and if your cost to borrow doubled, you might buy less of something. Just like you might buy less house, you might buy less car, no different. Here's where the news hits on Thursday, and then the market goes nuts. Then you trade after hours, and then when do they release their forecast? Once they release their forecast, we don't really get it because we're not watching that market. And then what happens later by the time the market opens? Well, you start opening up around here. Let me show you where that is. I believe it's right there. And then you just start lifting. And then what happens? Well, as that lifts, and you can see, actually, this is really kind of important. You can see how the Japanese 10-year just has been trading in ranges. Well, you're not trading in ranges anymore, are you? You're breaking out. Well, I would be breaking out too if I knew at 1% I had unlimited. Why would you even go out there and feel the need to buy bonds? If you know that you can do it at 1% and you're locked in, why not just try to short them as much as you possibly can here? Worst case scenario, the government will just buy you back. You have a backstop. Like, why wouldn't you just leave that trade on? How much are you going to pay in interest to carry that trade? Hardly anything. Okay? So if you think about it from that perspective, they put themselves in a bind, but at the same time, I understand what they're trying to do. They're trying to get out of this policy. And it's not the best policy in the world. And it did add a tremendous amount of fluctuation to the market and to their market. But the point that I'm getting at is the 10 years going higher, and then on top of the 10-year going substantially higher, the fluctuations you're seeing in the US dollar versus Japanese yen, how that can affect currencies and how that can affect sales, we could spend a lot of time on. We're not going to. It would take way too long. Now, Let's look at this on the weekly. Pretty decent range. Okay, let's look at this on the daily. Look at the drop you had on Thursday. Look at the undercut you had Friday, and look at the rally. So you had the single steepest drop here that you had in a very long period of time. I forget what the record was. They were talking about the movement and the volatility of that move in a one-day rate, and they were equating it out to years, like the idea of where you started versus where you are in that 24-hour time period. Now, when you drill into it, you can see what they're talking about, and you can just see how vicious that move was versus anything else that you have seen. And the reason for that is because what they did was so vicious. And that's why the market sold off on Thursday. And then when they, quote, clarified their inflation position and took their inflation numbers down on what they think inflation is going to be, guess what happened? It rallied, and so did the market. And that's why our markets rallied on Friday. And that's why when people were looking at charts on Friday, they're going, oh, we're definitely going lower, me, myself included. Oh, we're definitely going to go lower here. And then they're going to have to recalibrate their macro books, blah, blah, blah. And then on Friday, we're getting stopped out of trades, wondering what's going on. That is why. Remember, it's really important to get this concept, guys. Here's your stool. You have 3 legs to a stool. I know I go over this a lot, and there's a reason for it. That's your macro leg. That's your fundamental leg. That's your technical leg, okay? I can look at the market all I want, but when CPI was driving the market, we were leaning on that leg. And we all remember that from October S&P and how that marked the bottom. Didn't matter what earnings were. It was all about CPI and peak CPI. Then you get fundamentals. What's the company doing? Think Meta. Charts breaking down. Charts breaking down. I'm not going near that chart. I'm not going near that chart. But oh, by the way, earnings, record revenues, everything's rosy, and guess what happens? Stock goes back up. So now you're leaning on that stool, and they could have cared less about PCE when it came to Meta's earnings. And it wasn't the chart, it wasn't the technicals that moved Meta, it was the fundamentals. Now the chart's changed. Now you're going to be leaning on the technicals. It all moves. It's all connected. And you just have to know which leg you're leaning on. I know I go over that a lot, but there's a reason for it. So it's important to understand this is what happened in Japan. This is why we move the way that they are. We may even see more clarification over the weekend. Now, to put this in perspective so you can see what I'm talking about, you see this on Thursday? See how our bond market moved from a 3.85 all the way up to 4%? That was due to Japan. They're going to want a higher yield if they're going to continue to buy $1 trillion worth of our bonds. Then what happened on Friday? So the market's telling you what's happening. Okay? The market's telling you what's going to happen. And I think that's a very important distinction. They're starting to believe the inflation number, and this is what happened on Friday. And I just think that's an important distinction because we can benefit from it. Now let's talk about how we benefit. XLRE, okay? I'm just going to give you my opinion, and you can do what you want with it. I don't think every office building in New York City is worth zero. And that's where some of these companies are trading at right now. Now, I think some companies are better positioned than others. But what we saw is the equity markets are always lagging the bond market. And you can just remember that. The equity markets, they always lag the bond market. They just do. You rally up and then you break down and you're coming across. And then what do? You're dropping down because people still have hope. They held their stocks overnight and then they hoped that they were going to hold. What we do is we go through some trades and we see what's going on. This is one we bought in the Alpha Chasers community. If you are on the wait list, look for an email this week. We're opening up some slots. If you are not on the wait list and you want to be, there is a link in description and get on the wait list if you want to. Now we know where. What are we doing? We're breaking out. Why this one? Why does this one make sense? I'll tell you why. I'll give you the quick rundown why we did this one. I did this one and we did it, I think 31, 32. I was interested here and then we sold back down. This is the day they sold half of 245 Park for $2 billion, right? And the reason they only sold half is because they really didn't want to sell any. But why did they sell half? Because someone, a private equity firm out of Japan, go and figure, who wants to get yield, and they're borrowing money at what? 50 basis points, comes out and buys an investment in 245 Park, which is a great building in New York for those that know it. It's a great area. You see this and you're like, well, what'd they pay? Well, they paid $2 billion. Well, where's their mark? Well, they have it marked at $4 billion. Well, when I say mark, I'm talking their book value. The book value of this company right now is $77. Stock's at $37. No one believes the book value because everyone thinks that they're going to have financing issues and all kinds of issues. I know a lot of people in this industry. I'm just going to tell you something. If we think there's a problem and we're aware of the problem and we're smart, okay, then there's no longer this problem. If we're smart and we can already predict that in 5 years that SLG is going to have financing problems, how come no one pointed out the regional banking crisis until it happened? Maybe you'll find like one person, like a Michael Berry somewhere sitting in a basement. But other than that, no one saw that. Nobody. Okay, to sit there and then we're all going to discuss what the issue is. If we all know what the issue is, it's not an issue. As one of my friends that's actually in the large commercial business said to me, he's like, we're all aware. They'll have, their LTVs will just be more conservative and their rates will be higher. And they'll make less money, but the buildings are still worth what the buildings are worth. How I looked at this was when they marked here, and this is why we did this one, they dropped the dividend, but they're still issuing a dividend. It's based upon profitability. The book value is $77. I said, okay, well, during the great financial crisis, let's pretend we're in the great financial crisis and let's mark down their book. And let's drop the book 20% off of what it's already come down, which would be further than the great financial crisis. Well, that puts 20% puts me at roughly $60. Okay, so now we're at $60. Okay, we're in at 31. So I'm looking at this and going, let me get this straight. I get the park money here. We know what the book value is because they just did a mark here. That's why everybody bought here. Remember, we just went through the stool, macro, fundamental, technical. Then you flip and then you push. We're up $5-6 and a REIT getting money. And that's why I picked this one. I personally do not think every office building is going to zero. Just my opinion. Now, VNO is the more speculative one in New York. It has done exceptionally well and it's done better. My problem with VNO is that they have shuttered projects in New York City, which people like because they saved money, but they got rid of their dividend. And if you're a REIT and you're one of the largest REITs in the world and you can't structure yourself that you can still pay your during tough times. This is not a great financial crisis. This is, quote, tough times in New York, which it is. I don't think it's going to be Detroit, but it's tough times. Where am I going? I'm going and saying if you don't have the financial management wherewithal to keep a dividend going for your shareholders, well, then you don't care about shareholder value as much as SLG does. It's one that I'm interested in. And this works a couple different ways. I'll explain in a moment. The most conservative one to me is this VICI because you can't even build what they own anymore. It stays in the range. They own the top 10 highest valued properties in Las Vegas. It stays in a range. You get the dividend. Over 10 years, it'll go up. You can't even build what they own. You can't build MGM for what they own it for. There's huge value here, but it doesn't really move. It's more of a dividend stock. SLG, I still like on pullbacks. Do what you want with that information. But this is the same exact thing when we were telling people a year ago, if you go to Twitter or some of these older videos, when we were talking about the home builders a year ago, and nobody's getting it. Everyone's saying that, oh, we're definitely going to crash. No one's going to buy a house. Well, why? People have 2% mortgages, 3% mortgages. They're not selling their house. There goes supply and demand, Econ 101. Then we start pushing and we start rallying and now everybody wants to buy. Well, we were in these names a while ago. We just got stopped out of the last one. And why did these names work? Well, you were buying them for 50 cents on the dollar. You were still buying, up to 3 months ago, you were still buying BZH 50 cents on the dollar. Look at earnings. Look at earnings on Thursday. This is where I bought this. I bought right when we broke this DTL and then I got stopped out right here. It happens. On to the next one. But you can see how you fought right here and then you broke out. This was trading at 50 cents on the dollar. 50 cents on the dollar. Now look at it. Okay. Why is this important? Because what happens to people is they start believing, and this is why I keep saying cull your feed. Watch where you're getting your information from. Because people are going to be looking at this. I mean, look at this. Absolute monster. And we're all pointing at, this is going to crack, that's going to crack. Meanwhile, BZH is breaking out and going nuts. And you knew this was coming. I mean, Linear, Breakout. I mean, all of these names, KBH, they're all hitting all-time highs. TMHC was the one that we just got stopped out of. They're all hitting highs. They were all trading at discounts to book value. Well, that's great. I missed that. Okay, well, you can do what I'm explaining with the REITs still now, if you do your homework and dig into them. And I gave you the one that I have my single largest position in. Something to think about. Where is another sector that you could do this with? KRE. Well, why? Well, how could you do this with KRE? If you go back and look at these videos and they are all connected. All right. And I do appreciate your support and I really do appreciate when you share these videos. You can tell by this video you can guess how long it takes to put this video together. And I think it's more important to get them out on Saturday with a ton of information because during the weekday, it's a lot harder, I think. So do it big on Saturday and then we follow through for the rest of the week. And that follow through has gotten a lot of comments. People seem to like it. But I do really appreciate the sharing. I really don't want to run ads for people or for me to get more, I guess, exposure. Anyway, see this? You can, right? You see it? left, head, neckline. Where's the neckline? Pandemic. Okay. Nobody wants to buy here. There were two names that we kept going over. I'm going to give you a third one today. There are two names we kept going over in these videos. We own this one in the Alpha Chasers community. We paid, I want to say, I keep using different arrows. We paid roughly 8.5, 870. Okay, our target was 12. We hit it. It was a swing. I did analysis. I'm like, you know what? Their financials are really good. I'm just going to hold it. Our target was 14. We hit it. Some people will sell that target. To me, I'm getting to that point where I have a double. Now, if you ever get a double in a stock and it's like a low beta name and you tend to buy it right, what a lot of people will do is they'll cut it in half and then they'll just take that portion and move it to an account and forget that they own it because they never have to do anything with it, especially if it pays like a dividend or something. It's not the worst thing to think about if you're thinking about long-term and what to do with your capital. Why am I pointing this out? Because this one already moved. Okay, so then we would go, well, geez, I wonder who else got to buy assets from the FDIC. Okay, it was First Citizens Bank share. Oh, I wonder where that happened. Here. Look where you're at. Look who's coming out with earnings. No one's going to ring a bell, guys. Okay. When the FDIC allows you to merge or buy assets, they have done way more homework. The last thing they want is a merger and then a blow up, because that means that they were intimately involved. They okayed it and now they have a problem. These were the only two regional banks that were allowed to merge with another bank or buy assets until last week, when BANC was allowed to buy in the open market PACW. Now, this transaction did two things. Okay, the very first thing that this transaction did was allow us to understand that there is equity in these names. Well, how? Well, this was the first deal that was done, that was actually done for equity, besides UBS, Credit Suisse, which was just nonsense. But this was the first deal that was done for a regional bank where the shareholders got equity. Well, that tells you that PACW and these other banks are no longer in the trouble. Are we going to lose another bank? Yes, we lose banks all the time. We lose regionals all the time. If you go back, look last year, the problem, or the year before, we always are losing a regional bank. The problem is that the size and scope of the banks that we were losing scared the living heck out of people. But the mergers will make things better. You are going to convert this BANC into 0.66 of PACW. That's going to get your price. If you don't want the volatility, you wait until it's very close for the merger to go. If you don't care about the volatility, I mean, you could go, you can go long this one and short the other. It's up to you. Or you can just buy PACW. PACW is at a discount to the merger. I would just buy PACW and then just leave it alone. And then when it closes, it closes. And at least you get that price. But this could still fluctuate with BANC until it's done. But that to me means that next quarter's earnings on BANC, Bank of California, you're going to see a movement very similar to that. I hope that helps. Now, very quickly, we have gone through this before. This line here means that they are net sellers. All right, if you're selling down here, this is pessimism. All right, pessimism for their shares. So I'm only going to do 10 years. 1, 2, 3. You've had 3 times in history where financials have been here, where you have corporate insiders buying. We're clear, we have a depressed market right now, completely depressed, that we haven't seen since the pandemic. And we have insiders of financial companies buying more stock than they have only since the pandemic and this other place in time that happened during 2016. That's significant, and you should not sleep on this. There's a reason why they're buying their own stock. They're not selling it, they're buying it, and they're buying it at a clip that is significantly greater than the average over the past 10 years, and only 2 times higher, and both were significant events. New York Stock Exchange margin debt percentage of growth. I'm doing this to follow up. I get asked a lot to follow these up, and I don't mind doing it. This is Sediment Trader. It's a good product. I like it. And what this does is this just charts rate of change of margin debt growth. And if you're below 0, you can guess what that means, that there is negative and people are not adding. They are taking off. What? What are they taking off? They're taking off margin. Here, they're margining margin. They're basically taking out credit cards and then putting those credit cards on margin. That's pretty much where you're at here. January, marking that low, and then you just turned. People are going to start using margin. What I always like to do with this kind of data is I go back like 10 years, and maybe this one goes back a little further. Let's see. All right, we can go back even further. Let's see how far back they'll take us. Okay, I don't go back that far. We'll go back 20 years. Now, what can we learn from this? We can learn that here we flipped and we went higher. We could learn that when we flip here, we went higher. And here we are again. And then we did what? We went higher Just as you can see when you break, eventually you're going to come down here, and of course there, and now we're here. Something to think about. If they're putting more stuff on margin, if they're putting more stocks and equities or assets or NFTs on margin, then it makes a lot of sense. This is just me following up because I thought this was interesting. Now, smart money, dumb money. Again, this is Sediment Trader. I think this is very important for us to go over and pay attention to. Look where we're at here. Look where we're at here. Do you want to buy now or you want to buy when these are inversed? Okay, you want to buy now. Here's retail. They're overdone. Retail's going to sell, and who's going to pick up the pieces? Institutions are going to pick up the pieces. When you see these kinds of shifts, like you do here, let me get rid of that. When you see these kinds of shifts like you do here, and you see that widening of the spread, you want to pay attention to this widening of the spread. This is very interesting to me because they're out of position. Institutions are out of position still. They've changed it, but they're out of position, and now people are increasing their margin. People are increasing their margin, and institutions are out of position. And we have a cycle that we just went through where they can broaden out, right? Just gave 3 different sectors that are setting up to rally substantially. How long are they going to stay out of position for? That becomes the question. Now, you have a blackout window. That blackout window ends on July 28th. Now, if you put on your tinfoil hat, you'll find it very convenient that on the 27th, we had a huge drop. We were talking about this in the room. On the 27th, we just happened to have a huge drop on the Japan news. And then on the 28th, they just come out and clarify their statement. And it just happens to coincide perfectly with the peak corporate blackout window to the day. Kind of interesting. What's the blackout window? Firms are not allowed to buy their own stock. 80% of the S&P will have reported by August 7th. But those companies that report, you're not allowed to buy your own stock. You have a blackout window until the next day. Well, guess what the next day was? And that could be one of the reasons why we saw this happen with Meta, but we'll get into that a little later this week. But corp trading teams estimate that the open repurchase window will reopen on the 28th, conveniently the same day that Japan came out and said that news. We estimate that the corporate demand will increase by 35% during the open window. We estimate that corporate demand will increase by 35%. This is really important. You pair this out. Corporate demand will increase by 35% during the open window, or $5 billion worth of daily corporate demand. So you would take this information and then you would say, okay, well, who are the names and who has the single largest buyback programs, because they should be affected the most. Now, there's 2 ways to look at this. 1, you would look at the largest companies, and 2, you would look at the largest percentage. We're going to look at the largest companies. Now, these are some of the largest companies with the largest buyback programs out there. Apple, Google, Meta, Microsoft, Exxon, Procter & Gamble, and Lowe's. There will be other companies, and I would strongly suggest that you look into this and watch how those companies act next week. That's it.